Right now, financial markets have a massive gravitational pull. Capital is aggressively sucked out of standard portfolios to chase the explosive global AI boom. Holders of local assets are feeling the direct impact. FPT stock has seen a sharp wave of capital outflow and a significant drop in share price during this period. Much of this sell-off is driven by fear. The market is looking at FPT and questioning if a legacy company has the technical speed required to keep up with the global AI race. This creates a difficult choice. Are we watching the slow decline of an outdated tech company, or misinterpreting FPT's actual long-term strategy? In the tech sector, long-term losses often stem from confusing a period of market impatience with a breakdown in business structure. There is a wide gap between the wild expectations of meme stock AI growth and the sober reality of enterprise-level technology. To accurately evaluate FPT today, we have to set aside global FOMO and focus strictly on the underlying mechanics of the business. This chart tracks market divergence. While the global AI market follows a steep upward curve, FPT's price has trended downward, settling into a baseline zone around 70. As the gap widens, FPT holds steady. At this specific level, price movement stabilizes into a flat foundation. The objective for the rest of this analysis is to determine exactly whose portfolio this specific asset belongs in right now. At this price level, the asset presents a very different outcome depending on your specific investment timeline. Building foundational AI, the massive generative models run by giants like Google or Apple, requires an astronomical capital burn rate. FPT has deliberately stepped away from this top-tier global race. They have avoided the high-risk financial wars required to build original large-scale models. Their actual strategy focuses on the right side of this matrix: applied niche integration and regional focus. By utilizing their existing infrastructure within the Vietnamese market, FPT focuses on deploying AI tools into local enterprise environments where they already hold a technical advantage. This approach applies practical AI to established businesses to generate immediate, defensible revenue streams. The trade-off is clear. You are choosing to forego the potential for sudden, hyper-growth stock spikes to gain a more predictable business implementation. By focusing on domestic infrastructure, FPT operates in a localized, high-margin environment that avoids the volatility of the global model race. To understand their staying power, we have to look at the corporate architecture. FPT functions like a massive, slow-moving monolithic gear with heavy institutional momentum. Day-to-day operations follow conservative financial management, focusing on steady cash flow rather than speculative expansion. The significant influence of state-owned shareholders further anchors the company's long-term strategic direction. This ownership structure creates a buffer. During global IT volatility, the company relies on these institutional ties to maintain a stable operational baseline. The downside is speed. This corporate structure lacks the aggressive pivoting agility found in pure Silicon Valley startups. Choosing this asset involves a specific trade. You sacrifice the agility of a startup to gain the institutional backing and conservative cash management of a state-linked enterprise. This brings us back to the current market reality, with the price hovering around that 70 mark. We must distinguish between speculative, hype-driven pricing and the actual intrinsic value of the business. This bar chart represents FPT's intrinsic value based on current assets. The horizontal line meets the bar exactly at 70. Market anxiety has cleared away speculative premium, leaving the solid core business value. This valuation level functions as a foundation for future growth rather than a signal of internal collapse. However, this deep value is only accessible to those with a time horizon measured in years. The 70 price point aligns with the company's core business value, offering an entry based on current assets rather than speculative future sentiment. If you decide to act on this thesis, there is one absolute requirement. You must use strictly idle, unleveraged cash. Using margin leverage during periods of short-term tech volatility often leads to catastrophic results. Margin debt creates the risk of forced liquidations. It can break your long-term position and lock in losses during temporary price dips. Idle cash removes the threat of forced selling. It allows you to ignore short-term market noise and maintain your position. Accepting a lock on your liquidity is the required cost for maintaining this level of structural safety. To conclude, we can map different investor profiles to the reality of FPT's current setup. On the first branch, we have momentum traders seeking fast AI growth or the next massive breakout, especially those using margin. For this group, FPT is a poor fit. The slow structural pace will lead to frustration and high risks for leveraged accounts. On the second branch are long-term investors using idle cash who want a stable, dominant tech anchor in their portfolio. These investors can look at these discounted levels as an opportunity to accumulate and settle in for a multi-year hold. Profiting from FPT requires a strict alignment between your capital strategy and the slow structural reality of the company's growth.